Coinbase closed at $214.47 today, up 6.6% in a single session, and that puts the stock at its highest level in over 2 years. Now, a 6% move in a crypto-adjacent name on a green day is easy to dismiss as noise, but Coin doesn't move like a normal stock. It moves like a barometer. When it spikes, it's usually telling you something about how the entire market is repricing digital assets, not just for traders, but for institutions, regulators, and the broader financial system. So today, we're not just asking why Coinbase went up. We're asking what it means that Coinbase went up this much on this day at this price level. To understand today, you have to go back to early 2024. Spot Bitcoin ETFs launched in January 2024. That's about 28 months ago now. Spot Ethereum ETFs followed in July 2024. At the time, a lot of commentary focused on what those approvals meant for Bitcoin's price. But the less discussed story was what it meant for Coinbase specifically. Coinbase was named as the surveillance sharing partner and custodian for the majority of the major Bitcoin ETF issuers: BlackRock's IBIT, Fidelity's FBTC, and others. That's not a small role. Every time a large asset manager buys or redeems ETF shares, the underlying Bitcoin has to be moved, settled, and held somewhere. Coinbase Prime is that somewhere for most of them. So ETF inflows aren't just good for Bitcoin's price. They're direct revenue events for Coinbase's institutional custody and prime brokerage business. With Bitcoin sitting near $82,000 today, the notional value of assets Coinbase is custodying on behalf of these products has grown substantially from where it was at launch. Now let's talk about the regulatory backdrop, because this is arguably the biggest structural shift of the past 18 months. Through 2022 and 2023, Coinbase was operating under a cloud of enforcement risk. The SEC had filed a lawsuit against the company alleging it operated as an unregistered securities exchange. That case and the broader posture of regulation by enforcement created a persistent discount in Coin's valuation. Investors were essentially pricing in the probability of an existential legal outcome. By 2025 and into 2026, that environment shifted meaningfully. Legislative progress on digital asset market structure in the U.S. moved from stalled to active. The SEC's approach toward crypto platforms changed in tone and in practice. Coinbase's legal exposure, while not entirely gone, no longer sits at the front of every analyst's risk model the way it did in 2023. When you remove a regulatory discount from a stock, you don't get a gradual re-rating. You get it in chunks, on days exactly like today. Here's the part that makes Coinbase both interesting and volatile as a stock. The business is still heavily dependent on transaction revenue. Historically, transaction fees have accounted for the large majority of total net revenue in any given quarter. When markets are hot, that number surges. When crypto goes quiet, it falls off sharply. Coinbase has been working to diversify this, building out subscription and services revenue that includes staking, custody fees, and their blockchain infrastructure. Base being a key piece of that. But even with that diversification effort, the reality is that a rising crypto market lifts Coinbase's reported revenue in a way that's hard for almost any other business to replicate. When BTC is at $82,000 and ETH is at $2,343, the dollar value of trading volume and the fees attached to it is meaningfully higher than it was when those assets were trading at half these levels. The market is pricing in that revenue leverage today. Let's zoom out to the broader market. The S&P 500 tracker, SPY, is at $740.56 today. QQQ, the NASDAQ 100 proxy, is at $714.28. The VIX, which measures implied volatility in equity options, is sitting at 18.16. That's not a low-fear number historically. Anything below 15 is considered complacent. But 18 is also not a panicked market. It suggests a moderate risk, cautious optimism environment. That matters for Coinbase because Coin tends to amplify whatever the equity market is doing. In a risk-on day where tech is up and volatility is contained, crypto names typically outperform. The combination of a supportive macro backdrop with crypto-specific catalysts is what produces a 6.6% single-session move, rather than just a 1 or 2% drift higher. The VIX at 18 is essentially telling you institutions are hedging, but they're not running for the exits. Now for the harder question, is retail back? This matters because institutional flows through ETFs have been the dominant narrative for the past 28 months. But Coinbase's highest margin revenue historically came from retail users trading directly on the consumer app, not from large institutions moving Bitcoin between cold wallets. Retail traders pay higher fees per dollar traded. They trade more emotionally, meaning they transact at peaks and troughs rather than on a slow dollar-cost average schedule. And they generate the kind of volume that makes quarterly earnings look spectacular in bull markets. The honest answer right now is we don't know. Google Trends data, app download rankings, and social sentiment can give you a rough proxy. But until Coinbase reports its next quarter, we won't have hard confirmation of whether individual traders are returning at scale. What we can say is that a BTC price near $82,000 has historically been the kind of level that draws retail back in. Because it's a round number magnet and because it generates financial press coverage that non-participants actually see. Before you take this rally at face value, here are 3 things that have historically knocked coin back down fast. First, crypto-specific shocks. A major exchange failure, a stablecoin depeg, or a significant protocol exploit can reprice the entire sector within hours, regardless of regulatory progress or ETF infrastructure. Second, Coinbase's own earnings execution. The stock trades at a meaningful multiple to earnings, which means any quarter where transaction volume disappoints relative to expectations can produce a sharp correction even in a flat market. Third, macro reversal. If the VIX spikes back toward 25 or 30 on a deteriorating macro picture, rising credit stress, policy shock, whatever, crypto tends to be one of the first risk assets to sell. None of these risks have materialized today, but they are the reason coin can give back a 6.6% gain in less time than it took to build it. So here's the takeaway. Coinbase at $214.47, up 6.6% today, is not random. It reflects a company that spent 2 years absorbing regulatory, legal, and macro headwinds, and is now trading in an environment where several of those headwinds have structurally eased. Spot ETFs created durable institutional demand plumbing that runs through Coinbase's infrastructure. The regulatory cloud has thinned. Bitcoin at $82,000 and Ethereum at $2,343 mean the assets Coinbase helps move and hold are worth more, and that matters directly to fee revenue. What today's move doesn't do is answer the retail question, eliminate execution risk, or make the next macro shock less dangerous. Coinbase is still a high beta, sentiment-driven name in a sector that can reprice violently. The rally is telling you something real about the structural shift in crypto markets. Whether it's telling you something durable about coins specifically, that part gets answered over the next several quarters. As always, nothing in this video is financial advice. These are data points in context, not a roadmap.